Hey, everybody, I hope you're doing well. As we continue to head and glide slowly into 2024, we're already at the end of January, getting into February. What moves are you making with your money and your investments? Are you just kind of like a stick it and forget it kind of thing, or are you making some moves, which I think are very, very important? I am Jay, and thanks for coming back into the Real Estate Minute Show. I'm making certain moves with my funds, or have, starting at the middle of last year. This year in 2024, I just have no idea anymore. I'm not great at picking stocks. Every time I usually lose, I kind of play around a little bit, but I usually lose. But in this whole quagmire of different things to invest in, and some of the stuff we talk about here on the Real Estate Minute Show, what do you do, and where do you reallocate? If most people don't have financial advisors, and I have to say right now, legal disclaimer, I am not a financial advisor. I'm not giving you any advice, but what I'm doing with my money is I've started reallocating because I'm nervous. I think 2024, 25 are going to be very interesting years for this country, for the world as a whole. I don't know how the markets are going to react to it. Anybody that says that they know, there's another person equally as smart that says it's not. So I'm just being cautious. So I thought it'd be interesting just to show you where I started with my funds allocation wise and where I am today and what I plan on doing for the future. So let me just share my screen real quick so you can see what I'm talking about. Okay, so here's the summary schedule that I was mentioning that I just wanted to quickly breeze you through from the standpoint of showing you where I was before this year and where I am now and the changes I made and why. So this is just a real general schedule of the summary of my exposure, of all my investments lumped into general categories. Each one of these line items has its own spreadsheet with investments that make up each, but this is the summary that I look at. And generally speaking, if you can kind of understand the categories, this is mutual funds. These are index funds. These are ones that track, they're not individual stocks. They track the S&P 500. They track the Russell 1000. They track the Dow Jones. They do invest in individual stocks, but they invest in 3,400 stocks at one time. They don't invest in just a segment. This is money markets. It's a fund that just invests in money markets. It's very close to being a cash position, very, very safe and monitored. This is a market risk here. These are regular various mutual funds that are in segments like growth and income, healthcare. This is certificates of deposit, CDs, cash positions, meaning just held in a savings account or checking accounts. These are real estate notes, which we talk about a lot here in the Real Estate Minute Show. I've shared with you that I have a little business that I have a portfolio of real estate loans that I own, mostly against land and single-family homes. If you want to learn more about that, I've put it out here. You can go to the Real Estate Minutes YouTube channel, and you could see Real Estate Notes Demystified. It was released about 5-6 weeks ago. That's like the part 0 of a 4-part series. It's like the intro. The rest of the series is being released as a course, but at least you can get a taste. And then over here is business interest. This is investing in businesses, as it sounds, if you're interested. I've been interested in ramping that up a little bit. This is real property, land, and improved. I'm invested in just a little bit of land. I'm looking to further that as the future goes on. Real property, stagnant right now. I'm not buying anything. I'm not fixing anything. I'm not flipping anything. The last few years have been tough for that business. I don't see profit in it yet. Metals, gold, silver, etc., and bonds. Okay, so these are the general categories that we got. This is before I made any changes towards around July, of last year. I started making changes August, September, October, which then after the first of the year is my after column. So before is before I did anything. This is after. This is because I don't know what the hell is going on now this year or really in 2025. Things are up in the air, and I want to take market risk out of my portfolio and invest more in cash positions that are paying decent interest for longer periods of time, cash flow. So real quickly, so you can see kind of a general idea. So index funds, like I told you, it's not direct market, but it is market risk, but it's investing in indexes. I have reduced that a little bit just because of that market exposure, down by about a little over 10%. You can see it was 25, now it's 14. Money market, I increased just a titch from 6.5 to a little over 10. My money markets are paying anywhere between 4.5 to 5.25%. It's fantastic. You can see now the market risk, the direct market risk in segments of the market, I've drastically reduced by 30%. I barely am touching it at 8. CDs, I've increased because I'm looking to increase my cash position with CDs. Normally, I would never invest in a CD. I mean, 3% of my portfolio is in CDs. It's pretty much nothing. 21%, it's obviously 7 times that. So you can see what I'm doing here. And I'm getting, again, I invested in a 15-month CD the other day. It was 5.5%, and I'm just locked in for over a year. Cash, I've taken a lot of cash off the table, 10 and 3/4, and now I'm at 23%. Notes, I was at 4.7, I'm at 9 and a quarter. I'm still building that portfolio of business. I think we have about 32 notes now. And we're just going to keep building that business up. I love that business. And business interest, I am investing in a few businesses. I've increased it just a titch from less than 1 to 2.5%. Land, stagnant, and as I mentioned, looking to increase that. Not buying any improved property right now. No more metals or bonds, just a little bit more bonds. And that's what I'm doing. So you can see there is a drastic difference to just stripping market risk and going into longer term safe stuff that's paying 5%. I mean, 4.5%, 5%. Interest rates are slowly, I'm seeing CD rates even slowly coming down. Okay. Mortgage rates are one thing. Interest and savings rates are another. Okay. And they're starting just to creep just a hair. So I'm trying to lock up some decent rates, at least to get me through this year, kind of laddering CDs of 3 months, 6 months, 12, just so I have the room to do that. An interesting benefit also is taking risk and moving it more into cash is when you have cash available when things flip in the market. So for instance, I'm prepared with this cash now to slug into land, or if I start seeing it, an apartment building or something like that, or a few homes to flip or something, I can quickly and nimbly compete for that stuff and close fast. Other people may be locked up in the before column, and it's a bit more difficult to get cash out of mutual funds and all that stuff. All right. So I hope that helps to kind of look under the sheets of somebody else's portfolio. So as you can kind of see from that, generally what I've done is I've taken stuff out of the market risk. It's more very broad-based exposure and a lot of cash positions with high-yielding interest rates. It's great for cash flow, incredible rates right now. Try to lock up those rates as long as you can because the 5.5% CDs and money markets are not going to be around for a while. They're already starting to decrease a little bit. And that's why I've been locking up like 12, 15-month CD. Anyway, in a later video, maybe some weeks down the road, I'll get into exactly if there's interest in exactly what I'm buying, the actual ticker symbols of the fund and investments that I'm in. Take care of yourself. See you next week on the show.